Hello, everyone. Welcome to Money Minutes. This is Zach Gardezy. I am your host. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. So, for this week's episode, I'll talk about the latest on trade wars, what this means for the economy, and the latest jobs report, and what this means for inflation and overall portfolios. So, let's get right into it. So, here in the United States, we have over the last couple of weeks started to begin a series of tariffs placed on other countries, starting with Canada and Mexico, now with China. Now, the Canada and Mexico tariffs were quickly removed as all three countries came to agreements in terms of what they would like to see from each other, and suspensions were put in place for these tariffs. Now, the proposed tariffs were 25% on Canada and Mexico, and we'll see what happens over the next, roughly 20 to 30 days, and whether or not these tariff suspensions hold, or if maybe there's a more longer term solution between the three countries. So that's a good thing that we avoided these tariffs, at least temporarily. Now, the bigger deal and a risk that I've been explaining to Wealthstone clients over the last couple of weeks is tariffs with China and a potential trade war, which now is turning into an actual realized trade war, with the Chinese responding to our tariffs with their own tariffs on American goods and services, including liquefied natural gas, and even opening up an antitrust lawsuit against Alphabet, which is the parent company for Google. And so this has remnants of the United States banning TikTok, which is currently on pause. And now the Chinese may do something similar with Alphabet or with Google, right? And so this is going to have significant repercussions for not only our economy, but really the world economy, as, of course, the United States, Canada, Mexico, and China are very important trade partners in the global system. So now there are many schools of thought as far as what the value of tariffs are. It is no question that if tariffs are implemented, they will lead to potentially higher prices in certain areas, right? So it's something I want to stress. There is this blanket statement that tariffs lead to higher prices. Now, that is technically true, but it depends on what industries and what sectors are being hit with tariffs the hardest, which are going to see the highest levels of inflation and negative impact. Now, this eventually bleeds into the overall economy, as many sectors are typically affected at once, and then eventually into the global economy, as many countries are affected. But it's very important for investors, especially in the early stages, to pay very close attention to the details in many of these tariffs to see what industries and sectors are being affected, and not get too spooked out by some of the news and headlines that we read that either paint a very positive picture of tariffs or a very negative one. It's very important to be analytical in terms of what's actually happening, and then look at the odds, right? So what's going to happen? Is the United States going to maintain a long-term tariff on its closest neighbors for perpetuity, potentially leading those countries into recession and creating significant GDP loss here in the United States? I think that's highly unlikely. It's very clear that these tariffs and other practices are being used for leverage in negotiation. So are those negotiations going to be successful? That's where the market is concerned, and there's a lot of unknown. Now, as an investor, in my opinion, this opens up lots of volatility, which opens up lots of opportunities to invest, but you have to invest wisely and judiciously in certain areas of the market that you think are going to do very well. And so there is a lot of negativity around trade wars, and it, for the most part, is rightfully put. However, investors, again, should be very analytical in how they assess what's happening in the economy, and there could be some good opportunities that come out of this. Now, as it relates to the trade war with China, that is a major concern just because of how important of a trading partner China is and how interconnected our economies are. But most importantly, how much worse could this trade war get? I've spoken about this at length in previous episodes of Money Minutes, but sometimes economic wars can become kinetic warfare, and that's, of course, the worst case scenario between the United States and China. And so I'm paying very close attention to developments there. As we've talked about in regards to investments in AI and technology, it's a big deal when China and the United States are not on the same page, because a lot of technology investments have significant exposure to the Chinese market. So that is an area I'm very concerned about. and being very cautious with in conversations with my clients. And so there's a lot happening with tariffs and the overall economy. This is a concern for the Federal Reserve as well. They have talked about potentially delaying their rate cutting campaign just to see what happens with some of these tariffs and how inflationary they can get. Because at one end, the Fed worked so hard to try and bring inflation back down to 2%. These policies could potentially raise inflation. And so if the Fed cuts rates at the same time, they will only add more fuel to elevated inflation. So it makes sense why the Fed is on pause. And I think over the next 6 months, we'll get a lot more clarity as to what's actually going to happen with some of these economic policies. Now, I'd like to touch on the jobs report that was just recently released. So, this showed the latest non farm payroll information for the month of January. And there's some interesting information in there, and I'll help explain how to really digest it. So, the number of jobs that were added in January were 143,000 jobs, which was below the expected of 170,000 and down from December's blowout jobs report, which was revised to 307,000. Now, additionally, the unemployment rate decreased to 4% from 4.1%, and we saw wages increase as well month over month. And so, what does this all mean for your overall portfolio and really for the overall economy? So, immediately the market had a negative reaction to this. As I record this video on Friday, February the 7th, the market had a positive opening. Things were looking pretty good. Jobs report comes out, and the market immediately starts to nosedive. And this happened because the market digested this information and realized, oh, this doesn't help the Federal Reserve's potential for cutting interest rates in March. Actually, this hurts it. So now the odds of a rate cut in March are basically 0%. And we've talked about, the odds of a rate cut in March were already very low, but this definitely takes that out of the equation. And this is because the wages that we saw increase is a potential inflationary sign. And so that's going to cause some alarm bells to ring at the Federal Reserve, especially if we get more of these types of data points. Now, the relatively good news is that some of the latest inflation data that we're getting out of, for example, CPI and PCE reports is in line with a lot of economists' expectations. And so you're getting mixed economic reports, and it's going to continue that way with the combination of what I talked about in the previous segment with trade wars and also with the latest economic data with jobs and CPI and PCE, which are the prices and changes of goods and services. All of these factors are being hyper scrutinized right now to try and figure out, are we going to go back to some of that high inflation we saw in 2021 and 2022 and 2023, or are we going to continue this downward trend towards the 2% target that the Federal Reserve has? And the reason why this is a major concern for investors is because if we get back to some of those elevated inflation levels, there is a serious potential that the Fed can start raising interest rates again. Already we're seeing mortgage rates at 7 and 8%. Now, the Fed doesn't directly control mortgage rates, but of course, as they raise the Federal Reserve funds rate, that does impact other interest rates in the economy. And of course, when the expectations are of higher interest rates, the 10-year Treasury moves up, which is what we saw today as well in the market. And so all of these things do affect products such as mortgage rates. And when mortgage rates go up, the housing market starts to get stagnant or could even have some potential negative effects in the housing market. And so basically everything that happens with inflation, the economy, and with interest rates trickles into other parts of investments and the overall economy. So it's big news whenever we get reports like this and jobs, and it's a bit confusing because the number of jobs added was lower than expected, which shows cooling labor market. But when wages go up, that is a serious risk of inflationary pressure to come. And so the key point, though, is we want to pay attention to the reports and see if we're building a trend or a pattern of this. And so, at least for right now, I'm not overly concerned about the pattern. I still am optimistic that inflation will start to come down, but it is very closely tied to economic policies from the White House and what happens with tax cuts potentially later this year. There's a lot that's going to happen, and so investors need to be aware of volatility and what's going on. But nonetheless, I still remain optimistic, especially in areas such as artificial intelligence, technology, U.S. stocks, and so I maintain those investments for clients. But being cautiously optimistic and, of course, more careful with how we get into the market, especially at times like these, because there is a lot of potential for big negative swings in the market. And so you want to be careful with timing and how much you invest. And, for example, strategies such as dollar cost averaging could be very beneficial during times like these. Tax loss harvesting is great during times like these as well. So, if these are concepts that you haven't discussed with your financial advisor before, or maybe you're just concerned about your overall portfolio and the type of risk that you're taking as you head into this year, please don't hesitate to reach out. I'd be happy to review your portfolio for you. But this concludes this week's episode of Money Minutes. I hope you enjoyed these updates, and I'll see you again next week. Thank you.